Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Good afternoon, everyone. Welcome in. Welcome to Coasting in Retirement. So here we go today. I'm your host, Josh Knoll, alongside co-host Michelle Lee Melton, my radio partner in crime, my Auburn lady, trying to help keep my pea brain on track. Michelle, how you doing?
Soggy.
Yeah, it's been mid-July down here along the Gulf Coast. Been a little wet off and on, which some of our associates and clients appreciate if they're in particular industries. Well, Michelle, I'm excited to be back in studio. We had an extended 4th of July break. We're back,
America.
Yep, back at home in Coastal College's podcast studio here in beautiful downtown Fairhope. And I'm even more excited about the show we have today because, as usual, we have another great show for those of you tuning in. So listeners, Michelle and I are here to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. If you're just tuning into the show, we want to welcome you. And you're going to be listening to what we consider Lower Alabama's most dynamic and interesting financial radio show. We're here to entertain and enlighten you. And I can tell you, I can promise you, this is definitely not any type of infomercial type of show. I do have trouble with three-syllable words. So infomercial, you can say that for me, Michelle.
Yeah, infomercial.
All right, there you go. So here's what we got in store for you today. First segment, deep dive on our topic of the day. Second segment, it's about 20 minutes past the hour. Fan favorite, Michelle with the news of the week. Third segment, roughly 40 minutes past the hour, you will get to hear a good old-fashioned roast of yours truly with our Josh's crystal ball and big mouthpiece. So buckle up, we've got a lot to get to. Quick background for those, again, of you new to the show, my name is Josh Knoll. I am the owner of Gulf Coast Financial Advisors. That's an independent investment management financial planning practice with offices in Fairhope and Orange Beach, Alabama. I'm a fee-based financial advisor, and I hold my FINRA Series 65 securities license. Now, you can get more information on me and Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com. That's Gulf like the Gulf of Mexico, Coast, FA as in financialadvisor.com, or feel free to give us a call anytime at 251-327-2124. And don't worry if you just missed that. We will repeat our contact info several times throughout the show. All right, so here's what I want to do, Michelle, before we get into our topic of the day, our main topic. I'm going to ask you a question.
Sure.
How much do you pay attention to interest rates?
Well, I do and I don't. I'm not in the market for anything that requires a loan with an interest rate currently.
Okay.
And
All right.
the loans that I do have locked in interest rates. But it could still go up twice this year. I know that.
All right, so that's interest rates you pay. Let me flip it on the other side. How much do you pay attention to the interest rates that you get paid? When's the last time you shopped for a CD or you shopped for anything like savings account rate?
Nope.
Not so much.
Not so much.
Just went with the flow, whatever's available.
Right.
All right, well, this show is definitely for you then. All right, so first, a quick confession about what we're going to talk about today. I have been doing various podcasts and radio shows for several years now about a whole wide range of investment and financial planning topics. Sometimes we talk about things that are really complex and exciting at times. But not once in all of that time have I been even remotely excited about devoting an entire episode to what most would consider a pretty dry topic, what we referenced with Michelle's questions, interest rates.
Yawn.
That's right. So today, Michelle, we are going to be talking all about interest rates.
Riveting.
It's going to be. And here's why. First, this show is dedicated to the financial needs of those of you listening that are in or near retirement. So it's really not uncommon for you to rely on fixed interest investments, fixed income, and annuities for predictable returns, hence the topic fits. Second, interest rates are at their highest point since 2007, nearly 16 years ago, which is very important for some of the things we're going to talk about.
Yes.
And third, and really the reason for the show, we're going to try to solve this riddle. Is this as good as it gets as it pertains to interest rates? Should you be taking advantage of these rate offers by positioning more of your cash into them? Should you be looking at repositioning some of your portfolio? Do you have cash sitting on the sidelines? What does this mean to the rest of your investment portfolio, especially, particularly your equity and stock positions? We're going to dive into all that. So let's start with this. There are all kinds of investments and ways to gather fixed interest, But for the sake of brevity and Michelle's attention span,
Yes,
I'm
gnat
gonna,
brain.
That's right. I'm going to stick with the options that are most readily available to most investors. And also, I'm going to stick with the ones that I'm most familiar with. Some of these options that we're going to discuss, like bank CDs,
Not compact discs.
not compact discs, certificates of deposit, these are not something that I handle in my role as an independent financial advisor. But since investors will often shop money market funds, the things that I do against CDs, I felt it was important to add them. And since our regular listeners know that Michelle loves her some odd numbers, I decided to keep the list to a simple 5.
Hooray and thank you.
There you go. So let's do this. Let's get to our list of 5 ways for investors to take advantage of current high interest rates. Then what we'll do, we'll list them, and then we'll circle back and discuss each more individually. So here we go. First up, we just reference it, money market funds. A money market fund is a type of mutual fund that invests in typically highly liquid near-term investments. That means they have a very short maturity date. These investments can include cash or what's called cash equivalent securities, usually high credit rating, debt-based type of securities with a very short-term maturity. Listener, think U.S. Treasuries is one example. Money market funds are intended to offer investors high liquidity with a very low level of risk. Not no risk, as Michelle and I will discuss in her Michelle with the News of the Week, but at least low risk. Money market funds are often referred to as money market mutual funds. Okay,
That's a lot of M's.
That's a lot of M's. So that's a MMF. Okay.
Mm-hmm.
So, all right, that's number 1. Number 2, we just referenced it as well. Bank certificate of deposits or CDs, not the music kind as Michelle laid out. These are the types of savings accounts typically offered by banks or credit unions. Generally, most folks that are listening to this program have had a CD at some point in their life. Even a lot of times kids will have CDs. You generally agree to keep your money in the CD for a period of time, usually between 3 to 12 months, but it can be as long as 5 years. And I believe, because again, I don't deal with CDs other than on the retail side, just like a consumer would, but maybe in up to 10 years with some banks. And you do that, if you put it in there, you don't get a penalty if you don't take a withdrawal during that period of time. Of course, on the converse side of that, if you do withdraw your money early, you'll pay a penalty to the bank. Okay? All right, you got a question, Michelle?
I'm kind of shocked that the term can only be as little as 3 months.
Well, yeah, they can go pretty low. Now, I think
Wow.
most people do 6 to 12 months, I would say, in general.
Okay.
Well, we're going to find out with our episode, aren't we?
Uh-huh.
All right, so next up, no particular order, number 3 on our list of things that have a relatively high interest rate compared to at least recent history are multi-year guaranteed annuities. These are referred to as MYGAs.
MYGAs, not MEGAs?
Not MEGAs.
Because I was curious about that.
They're MYGAs, and they're not your favorite. Your favorite is SPIAs.
Yes.
Yeah, you like saying that word.
I do.
But these are, it's not a SPIA, it's a MYGA. These are type of fixed annuities that provide a predetermined, contractually guaranteed interest rate for a specific period of time, usually 2 to 10 years, most of the ones that I see. MYGAs, as you can tell by the definition, are going to be the ones that are most often compared to bank CDs. But remember, listeners, that MYGAs are offered by insurance companies, not banks. Therefore, a MYGA will be backed up by the paying ability of the insurance company, whereas a bank CD would be backed up at least up to $250,000 by the FDIC, insured by the FDIC. Okay, very good.
All right.
Number 4, and this was one, so Treasury Securities, specifically what's called T-bills, T-notes, and T-bonds. And I'm going to be honest with you all. I have at this point taken upteen securities tests for my various securities licenses that I've had in the past at this point in my career, and I still get these all mixed up. So let's just start with a basic definition. All the Treasury securities, U.S. Treasuries, they are issued by the U.S. Department of Treasury on behalf of the federal government. They carry the full faith and credit of the U.S. government, which is supposed to make them one of the the safer investment.
Supposed to.
It does. It's one of your safer investment choices. Quickly, most U.S. Treasuries will include T-bills, T-notes, T-bonds, and then what's called TIPS, and we'll get into those more here in just a little bit. Okay. All right. Number 4. We have 4 on 5.
No, we're on 5 already.
On 5. So good old corporate and municipal bonds.
Ugh, skunking it up.
Now, all these are good stuff. Now, not all. You're just because I know where you're coming from.
Yes.
But they have made a comeback. What you're talking about? These are debt securities, usually issued by a private or public corporation. On the corporation side, with corporate bonds, you've got 2 broad types. You've got investment grade and you've got high yield. Now, some of y'all listening, particularly if you've got some experience in the industry or in buying these things, you will automatically know that high yield is often called junk bonds. And we're going to talk a little bit more about that in this episode. Now, with municipal bonds, they're called munis typically. These are debt securities offered by states, cities, counties, other government entities. Michelle, I don't mean to put you on the spot, but I believe you dealt in your previous roles, you've dealt a little bit with muni bonds. At
Correct.
Least, right.
Yes.
Okay, very good. You've got, and I know you're probably going to pipe up on one of these, but you've got general obligation bonds, you've got revenue bonds, and you've got conduit bonds, which I was actually not super familiar with. So
I think of an electrical conduit, not bond-wise.
That's right. All right, so here, this is what we want to do. So let's talk about these again. Let's list them one more time. These are the 5 things that right now, at least compared to recent history, are paying what most folks would consider at least a higher or competitive interest rate. We've got money market funds. We got bank CDs. We have multi-year guaranteed annuities, which are called MYGAs for short. We got Treasury Securities, and we've got corporate and municipal bonds. What we're going to do is we're going to dive into each category individually and quickly, but I do want to give a quick note. While these types of fixed investments, interest investments tend to stay pretty static over the past several decades, at least the offering types, the interest rates can and will vary significantly. Some of these will vary daily, which means, unfortunately, that if we mention some of the current available rates, even here you're listening to this episode potentially on 106.5 FM here on a Sunday, these rates that we discuss in the show may not be available tomorrow or Tuesday or Wednesday. It's just how the market works. But that's one of the reasons we're talking about, is to hopefully answer the question, is this as good as it gets? So, all right, Michelle, I'm going to pivot back to money market funds. And what I'm going to do, I'm going to give a couple specific examples. And you've got some familiarity here. I'm going to start with Schwab, Charles Schwab. You call him Chuck.
I do.
Yeah, he is one of our custodians that we use. We use him. We use them and Fidelity.
Yeah.
Schwab has a current, and I want to make sure I do a little disclaimer here. I'm not laying out this particular money market to try to sell it or anything like that. It's just one I've got familiarity with. They've got one with a ticker symbol as SWVXX. That's Sam Walter Victor XX. The current 7-day yield on this Schwab money market account is 4.96%. There's no minimum investment. It does have a kissing cousin called SNAXX that pays a little bit more interest. It's around 5.11, but that one requires a minimum deposit of $1 million.
Oh.
Not terribly uncommon, but I bring that up because we wouldn't even be having this conversation a year ago. There was not a money market paying 4.96%.
What was it doing?
I tried to find the old money market rates. It's kind of hard to find.
0.25%?
Well, the thing is, there's just so many options that it's hard for them to have a specific example. But the main thing about these things are they're going to be ultra short term. They're intended to have quite a bit of liquidity. Now, they're not going to be as ultra liquid as cash, but you're typically talking 24-hour liquidity. With these ones I referenced by Schwab, they're going to hold a lot of what's called commercial paper, notes, repurchase agreements, CDs, things like that. For someone that wants maybe something with a little bit more government money or treasuries involved, there's definitely money market funds available with those. They tend to pay just a little bit less than what you would see in kind of the more corporate environment, if you will. And then, of course, there's always municipal bond money market funds, which are a collection of municipal bonds. But at least for right now, the yields tend to be a little bit less. The ones I looked and researched tend to be in the mid to high 2s, okay?
All right.
All right. Next up, we talked about bank certificates of deposits or CDs. Now, here's the funny thing, Michelle. We did some research on the show, and I was, I guess, this week years old when I realized there was such a significant difference between what online banks were offering versus what traditional brick and mortar banks were offering for CD rates. So what we did, it looks like if you look on rates on the internet, there appears to be several options in the high 4s to low 5s interest rate for 12-month CDs. But back to my point, I don't recognize a lot of the names on that list.
I didn't either.
Yeah, so I'm assuming they're online banks, right?
I guess. I mean, I have some, but is Credit Karma something like that? I mean,
that's definitely online. They must have formed their own bank. But what we're going to dive into more in depth later in the show. I did call our local Alabama credit union, and they are offering 4.5% for 7 months with a minimum of $5,000. So they're at least in the fight. They're in the fight anyway. There,
right?
All right. Next up are multi-year guaranteed annuities, MYGAs. So these, and again, not SPIAs like Michelle's favorite.
SPIA.
So here's the thing. I did some research. I have access to a wide variety of MYGAs. We use them very similar to as somebody would use as a bank CD. It looks like a company called American National Insurance is still sitting pretty strong here. They've got a 5.45% offering on a 7-year MYGA.
What's the deposit?
Well, no, you know what? That's a good question. I believe it was a minimum of 20,000 or 50,000. There's even some 2-year stuff out there sitting at 4.6, 4.7, which the point of all that is, again, these rates will change. The MIGA rates, generally speaking, tend to change every couple of weeks, but it really is just astonishing to compare to where these rates were just last year. The main thing you want to remember on this, and also with the CDs, but particularly with the annuities, that the surrender period is going to be important for you when you're looking at purchasing these. That rate I just quoted you, that 5.45, that's got a 7-year surrender. Now, typically, so what that means is if you take the money out in less than 7 years, you're going to pay a surrender fee. Now, typically, the insurance companies will give you access to about 10% per year, which kind of helps soften the blow, but there's always going to be some type of surrender charge. All right, next up, the one that makes my tongue twist, Treasury Securities. So here's what we've got. We got Treasury bills, we got T-notes, T-bonds, and TIPS. T-bills are shorter-term securities. They normally mature between a few days and 1 year. I went on Market Watch, which is a website we use a lot. And according to them, and they have up-to-date information, as of recording right now, they're offering on a T-bill 5.25% on a 1 month and 5.34 on a 1 year about. I rounded because they go out 3 or 4 digits on those. Right. T-notes, those are a little bit longer term securities. They're going to mature between 2 and 10 years. They do pay the interest biannually. Again, according to Market Watch, there was one paying 3.85 for a 10-year Treasury note. You say, well, Josh, why is, you just told me that if I lock it up longer, I get a higher interest rate. Why is that rate lower than the T-bill? Well, because I don't think the government, the Fed, and most consumers expect us to stay in this high interest rate environment for 10 years. We hope not.
I hope not.
Because that means we've had inflation for that many years, more or less. Next up, Michelle, we got T-bonds. Those are longer term securities. They typically mature in 20 to 30 years. They pay interest every 6 months biannually. 3.95 on a 30-year Treasury bond. So kind of you see where the story's going here, right? Mm-hmm. And then lastly is TIPS. These are Treasury inflation-protected securities. That's where they get the TIPS name. These are going to be notes and bonds where the principal is adjusted based on changes in the consumer price index, what's referred to as the CPI. They do pay interest every 6 months. They are issue of maturities of 5, 10, and 30 years. But unlike other Treasury securities where the principal is fixed, the principal of a TIPS can go up and down over its term. With it going up and down, that means the amount of interest that you receive can go up and down. The one thing that is, I guess, appealing about them is they are, if the principal, when the bond matures, if the principal is equal or lower than the original amount, you still get the original amount. So they got some principal protection there. Okay, and then last up is going to be the corporate and municipal bonds. So let's talk about corporate bonds. There's 2 broad types, Michelle. There's investment grade, which is probably what you would have been familiar with in your previous roles. That means the underlying company has a higher credit rating, which is intended to imply less credit risk than what is the other kind, which is called high yield, which a lot of folks have
junk.
Well, they've been referred to as junk bonds, but I will say this: don't let that necessarily scare you away, listeners. You just got to be a little more careful with your selection. But high yield definitely means it's going to have a lower credit rating, means that it's going to have a higher credit risk by definition than the investment grade bonds. It doesn't mean that they're all junk. It just means that there's, it's kind of like going to the flea market. You got to look around.
You got to pilfer through things.
You got to pilfer through things. There you go. All right, so folks, that is the list we had today.
Riveting, isn't it?
It is. Is this as good as it gets on interest rates? We talked about money market funds. We talked about bank CDs. We talked about multi-year guaranteed annuities, MIGAs, which is the insurance company's kind of competitor equivalent to CDs, bank CDs. We talked about Treasury Securities, and we talked about corporate and municipal bonds. What we're going to do coming up in the next couple of segments, we're going to dive into various headlines and news that help you understand all these, particularly because I threw so many numbers at everybody, did I not?
Numbers and abbreviations, all very dry.
Well, a little bit, but we're going to make it interesting.
Okay.
Now, folks, if you're interested in continuing conversation about the things that we just said there, why don't you give us a call at 251-327-2124 or find us at gulfcoastfa.com. One more time, that's Gulf like the Gulf of Mexico, Coast like the name and the title of the show, and FA as in financialadvisor.com. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance, and this particular week was certainly an example of big news in finance, as always. This is one of the easier segments we get to do. at research. Would you agree? There's always something out there.
Oh, yeah. And I read some stuff today I might throw in here, too.
Okay, very good.
So.
Well, what we do every week, Michelle and I scour what she calls the interwebs for helpful financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. So join us after the break to hear Michelle and I discuss this week's relevant headlines in our Michelle with the News of the Week segment. Stay tuned.
Support for Coasting in Retirement is provided by Synergy Home Care of Daphne. At Synergy, we understand that people are happiest and healthiest where they are most comfortable, in their own homes. From companionship to around-the-clock care, we offer a range of in-home care services so your elder loved one can confidently age in place in the familiarity and comfort of their own home. In addition to seniors, we proudly provide wholehearted in-home care and support services to your loved ones who are living with a chronic condition, recovering from cancer, illness, or surgery. From personal assistance with bathing and dressing to senior companion care to fight isolation and loneliness, to support with housekeeping, errand, and transportation services, sometimes just a little extra help at home can make all the difference. You can reach Synergy Home Care at their Daphne location by calling 251-621-1900. That's 251-621-1900, or by visiting synergyhomecare.com. SYNERGY homecare.com. Mention you heard us on Coasting in Retirement and receive 10% off your first month's service.
Welcome back to Coasting in Retirement. Your host, Josh Knoll here. So as we discussed before the break, every week Michelle and I scour what she calls the interwebs for helpful financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. Michelle and I are going to help you all understand and decipher the deeper meaning of these headlines, or at the very least, provide some context. So without further ado, here's Michelle with the news of the week.
All right, Josh, let's ease into this using a site we reference often, Investopedia. They have a recent article titled Money Market Funds. What they are, how they work, pros and cons. Seems straightforward enough. Anywho, as one can imagine, this article lays out the basics of money market funds in the straightforward and dry language that we've become accustomed to with Investopedia, and it's much appreciated. So I learned from this article and also from you on the beach this weekend that a money market fund aims to maintain a net asset value, NAV, known as NAV, of $1 per share. And apparently it's a big deal if it falls below this level. It's called breaking the buck and has only happened a few times. And this is where it gets crazy. The first time was when I graduated high school back in somewhere in the 90s. I won't disclose that. No.
Do your Google research, listeners.
Yeah, right. And the other during the 2008 financial crisis. And both times it produced quite a bit of turmoil. And we were around for both, but 2008 mattered more, obviously.
100%.
Yes.
Yeah, we were too young to pay attention to the
right.
first one back in 1990-something.
That's right. So here's what I'm looking for from you. Please explain NAV in more detail, how money market funds try to avoid breaking the buck, because it's real bad, and what this all means for folks looking for a fixed interest investment.
Well, so first thing, listeners, I graduated exactly 1 year ahead of Michelle, yet because of birth dates, there are times where I'm 2 years older.
That's right.
And a lot of times she'll say...
Like right now.
Yeah, she'll say, when she's talking about people, she'll say, well, folks my age, and talking about herself. I'm like, you mean our age? Yeah, our age. So, all right, so answer your question, Michelle. Net asset value, that's going to be the net value of an investment fund's assets minus the liabilities, and then they're going to take whatever that number is and divide it by the number of outstanding shares, okay?
Okay.
So common, easy math.
Right.
Let's say you got a company where the assets are worth $2 million, liabilities are $1 million, and you've got 10,000 outstanding shares, okay? So that's 1 million, or 2 million minus 1 million is 1 million. Divide 1 million by 10,000 shares, that equals...
You lost me.
Well, $2 million in assets, $1 million in liabilities. Take that, subtract that. Divide by the 10,000 outstanding shares. So that's 1 million divided by 10,000. That equals $100 per share. That would be the NAV.
Okay.
The NAV is commonly used. It's as a per share value. They usually use it to calculate the value for a mutual fund or ETF. and it's calculated at the end of each trading day. ETFs, you'll see them kind of updated as the trading day goes on. Mutual funds close at the end of the day. But the point being is they're going to be based on the market prices of the portfolio securities. That's how the NAV is determined. Now, back to your point, breaking the buck, that occurs when the NAV, the net asset value of a money market fund, falls below $1, like you said. This may happen. There's a couple reasons it happens, and it is actually a big deal. And I think the two instances you referenced were the only 2 times it's done. I don't think our research showed any more times. Listeners, if you know of more times, shoot us an email or a message. But this typically happens when a money markets fund investment income is not covering its operating expenses or its investment losses. Or I would say more normally, probably in particularly in 1994, it occurs when interest rates drop to very low levels, and maybe the fund has used leverage to create some capital risk in what is typically a low-risk environment. Either way, with it only happening a couple of times, historically, money market funds are a safe way to store cash or park cash on the side and at least get some interest rates. The reason that we're even talking about them now, because interest rates are actually pretty attractive, relatively speaking, historically, but these rates are not constant. So once you come out of the higher rate interest rate environment that we're currently in, a lot of times if you've had money parked in these type of investments, it may be time to get back into the stock market. If you got questions on that, if you've got cash sitting on the sidelines, or maybe you're somebody that is grown uneasy with the volatility of the stock market, give us a call. We can help you navigate through the various money market fund offerings in our role as financial advisors. 251-327-2124. Very good. What's up next?
Well, going back to that article, though, too, I'm still not clear as to why you would use the funds because it's short term, but because it doesn't seem ideal for me anyway.
Well, you're saying why would you use a money market fund?
Yeah, because it's short term as opposed to long term.
Well, but okay, that's a great point. But think about it this way, Michelle. Yes, the rates are going to vary, but right now we're going to be in high interest rates probably for a foreseeable future.
Yes.
It has been since you and I were in, oh my gosh, college? Maybe not
college.
Maybe not quite that far back, but it's been a long time where somebody could buy a money market fund and get around 5% in interest return. That's
right.
Historically, that's pretty strong. I mean, think about it. A lot of times you're managing a very conservative portfolio and hoping you're coming out in that range. And even with a conservative portfolio, you sometimes got a little bit of stock market volatility. With a money market, generally speaking, you're just going to see that interest credited, and that can be pretty attractive to somebody who's trying to preserve capital. What you got next?
Okay. Next is an article from the folks at Smart Alec. Just kidding. I mean Smart Asset. I'm going to take a guess that the people that started Smart Asset were a little bit of Smart Alecs themselves and probably had to add a vowel and a consonant.
Had to add the ET at the end.
Yes.
I'm sure that's the only way they got through their compliance.
I think of there's the big ass fans and stuff like that too. But anyway.
Right.
So Smart Assets article states, what is a multi-year guaranteed annuity, MYGA,
right, for
short, that we learned today, definition and benefits. I know we've discussed annuities often on this show. There were a couple of words that stuck out to me in this article, such as surrender period, surrender fees, qualified versus non-qualified, and tax deferred. Can you explain in more detail what these phrases mean in the MYGA space?
All right, very good. So we'll start with surrender period. That's going to be how long until the annuity matures, or in other words, how long you agree to keep your money with the insurance company per the contract. Surrender fee, that's going to be what you pay the insurance company if you pull your money out during the surrender period. And usually surrender fees, Michelle, are defined as a percentage of the premium invested.
Okay.
So for example, if you pull it out in the first year, it's 10% surrender.
Oh, so it goes down if you let it go out?
Generally speaking, it decreases over time to where, let's say if you're on a 7-year MYGA, by the time you get to the 6th year, let's say that surrender fee is down to 3 or 4%. I'm doing it off the top of my head, but that's generally how it goes.
I track that.
All right. So next, qualified versus non-qualified. I talk about this a lot because it's a fairly simple concept or fact that a lot of people don't know. A qualified account in general is going to be any type of investment account where the government gives you, or the IRS, gives you some type of tax preferential treatment. So think 401ks, think IRAs. You put in the money, there's some type of tax deferred, there's some types of pre-tax deduction. Now, in exchange on a qualified account, usually there's an ask, or there's a give on the front, there's an ask on the end. The ask is once you start taking money out of qualified accounts, typically in quote-unquote retirement years, 59.5 to 72, then you've got to pay whatever your current income tax rate is on that distribution, okay?
Okay.
Non-qualified does not have any of that. It doesn't have any of the tax preferential treatment.
Ooh la la.
Well, but I mean, so think of it. You have more than one checking account, right?
Yes.
Okay, so those are kind of low-level versions of a non-qualified account, savings account, bank CDs. It's anything held outside of a tax-preferred wrapper. And with those, if you make, like you've said you've had some CDs in the past, CD made interest, you get a little 1099 from the bank at the end of the year, add that to your taxes, off you go. There's no tax deferral. One of the things that is probably at least appealing to some investors on a MYGA is that even in a non-qualified setting, they still offer tax-deferred growth. Now, they're not tax-free, but they have tax-deferred growth, not dissimilar to what you see in some of your qualified accounts. What that means is you're still going to owe some taxes at the end of it when it's all said and done if you've collected your interest. But during the time period, you're getting tax-deferred interest. And the kind of cool thing is, as long as you keep everything in there and you don't take advantage of maybe like the 10% withdrawal that a lot of contracts have, you're going to get interest on interest. So you're going to get, you're going to make it, let's say you got $100,000, the MYGA pays 5%. Now you got $105,000 coming out year one. For the year two, you're going to get 5% not on $100,000. You're going to get 5% on $105,000, and so on and so forth, right? And it kind of adds up. I mean, especially again at these high, is this as good as it gets at these high interest rates that we're seeing? I've seen them. The MYGAs that I track, I haven't seen any of them push past the 5.4 mark yet. So it can be interesting the next couple of weeks to see how that plays out. So good job, the Smart Alex at smartasset.com. All right, what do you got next?
So for our last article, in past episodes, we've referenced articles from one of the custodians you used, Chuck Schwab, but I believe you also use Fidelity. You do. We talked about that.
I do.
Okay. So I found this recent article on Fidelity's site simply titled Risk of Fixed Income Investing. And as what one would call a regular investor to my retirement plan, I found it interesting that something I consider relatively safe would have this long list of risks, like a prescription drug.
Kind of, yeah. Right. Yeah, the disclaimer right at the end of the
it's
commercial.
Worse than what you have. Okay.
Right.
So I get the interest rate risk because we talked about how rapidly increasing interest rates wreaked havoc in the bond market last year. But I guess I did not realize that bonds also dealt with prepayment and call risks. As someone that often uses bond funds in your clients' portfolios, can you please tell us more?
I can. All right. So that article came from Fidelity, right?
Yes.
So even though historically bonds in general, they've always been considered a safer investment, at least compared to stocks or equities, they still do have some risks. Now, we've already discussed one of the biggest risks in our episode here. We've talked about interest rate risk. Rising interest rates, especially on longer term bonds, tend to depress that bond's price.
Boo.
But there's also credit risk, which now credit risk, typically you would see that on a high yield bond, what is commonly referred to as a junk bond. But every once in a blue moon, it's not common as a junk bond going defaulting, but it's definitely way more common than a money market breaking the buck. Every once in a blue moon, a city goes bankrupt. And okay,
not so much in every blue moon.
Well, that's fair, but I'm saying ones that have outstanding municipal bonds. It doesn't happen a lot, but it does happen.
Yes.
Okay. All right. And then there's call risk. You mentioned that. You would find call risk on what's called callable bonds. Those are bonds that are going to have a provision that allows the issuer to call or repay the bond early. And so why would they do that?
Why would they do that?
If interest rates drop low enough, the bonds issuer, which we're in the reverse environment, but if they were to drop, the bonds issuer can save money by repaying its callable bonds and then issuing new bonds at a lower interest rate. And a lot of times you're just stuck taking a new bond. Now, there's a similar risk to that, Michelle, called prepayment risk. You mentioned it. Normally, you would see that on a mortgage-backed bond.
Okay.
And what that is people pay their mortgage off early. And if it's in a particular bond and there's several of them paying off their mortgage early, that amount of interest being paid in is now off the table, and there's going to be some prepayment risk on that. And then lastly, in that article, there's going to be liquidity risk. And what liquidity risk is, if you just happen to, you buy a bond that, no one right now, or at least very few people want to buy it anymore for whatever reason, and now your bond holdings are underwater. We've seen that happen to several muni bonds over the past year. Mm-hmm. That's liquidity risk. It's like, okay, is there a buyer for my bond? And if so, is it a limited buyer pool, which means, again, I went to the Harvard of the Midwest, Missouri State, with an economics degree. If there is more supply than there is demand, prices tend to go down.
I get that.
Right? Yes, that's the only thing I remember, but I remember that. All right, that's good. A good article
Sure,
about
and
Fidelity.
law of diminishing returns.
Now, I want to say one thing before you go to your next article. We do help people navigate when they've got bonds underwater. It's one of those things where once you kind of get over the aggravation and the pain of it, and you can treat it as a challenge and a puzzle to put together, there are ways to work through this thing and try to at least make the best of a bad situation. We can help with that at Gulf Coast Financial Advisors, 251-327-2124. All right, so Michelle, great job with the headlines as always. These are important pieces of
welcome.
information and impacts those are entering in retirement, even if it doesn't interest Michelle a whole lot. Those of you listening know that there are a lot of attractive options out there right now for the first time in a long time. So listeners, if you have questions around these topics, around these interest rate discussions, around underwater muni bonds, any of those things, why don't you give us a call at 251-327-2124. You can set up a conversation, set up an appointment, no obligation, no fee, no pressure. You can all reach out to us via our contact page on our website, gulfcoastfa.com. That's GULFCOAST, FA is in financialadvisor.com. All right, folks, coming up next, Josh's crystal ball and big mouth. What have been some of my predictions? Have I been right?
Have you been wrong?
Was I ever wrong?
Yes.
How wrong?
Sometimes very, sometimes not so much.
Well, what we want to know is what do I think is going to affect investors in the near future?
That's right.
And maybe the far future. We get to talk about all these things and poke a little fun at my big mouth. Stay tuned.
Imagine for a moment that an intense storm is pounding your house. Will your roof leak? Will the siding peel away? Will your basement flood? If your house is properly built and maintained, you'll be fine. What about your 401k or investments? The stock market has had a great run the last few years, but is its current turmoil making you feel uneasy? Are you confident your portfolio is built to weather a financial storm? Well, now might be a great time to get a second opinion on your retirement plan. Call Josh Knoll and the team at Gulf Coast Financial Advisors, 251-333-5151. They'll examine your portfolio and show you if your investments are in need of some weatherproofing. Get your no-obligation second opinion by calling Josh Knoll and the team at Gulf Coast Financial Advisors, 251-333-5151. Don't let your retirement get caught in the rain. 251-333-5151.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
All right, welcome back. Your host, Josh Knoll here, alongside co-host Michelle Lee Melton. So folks, I tend to be opinionated. I do have strong opinions at times. And to be fair, I would say a radio show host that isn't at least a little opinionated probably wouldn't be very interesting to listen to. So I am paid in my profession to offer professional guidance and opinions to my financial planning, investment management clients. Otherwise, what use would I be? So sometimes I feel so strongly about something that I talk about it publicly on the various podcasts and radio shows I've had over the years. Sometimes I'll even make predictions. And while, selfishly, I feel like I'm usually proved right because I tend to be somewhat skeptical about investments and finance, there are times where I swing and miss. So if you all want to hear me eat a little crow, let's get on with it with Josh's crystal ball and big mouth. Michelle, what you got first?
Okay, so several months ago, you stated that rapidly increasing mortgage rates would lead to a significant housing market decline and that you felt bad for your realtor friends, especially those just getting into the career. Well, according to recent research, despite higher mortgage rates, the housing market remains as competitive as ever, thanks to strong demand coupled with tight inventory supply, due in part to those who purchased homes in recent years at record low interest rates, me,
right?
staying put. And locally in Baldwin County, all appearances is that the market is doing just fine, and with listings and home prices both up significantly from last year. Although I do actually track this stuff. And
You're pushing back a little?
I'm pushing back a little because I get updates and stuff that I looked at on Monday has gone down $50,000 today.
Okay. There you go.
That's serious. That's from like some of my stuff that I get because I stare at the stuff. So I don't know if you're really on top of it on that. So anyway.
Well, let's talk about, so this is my opinion on my big mouth, right?
Yeah.
So, and here's the thing, you kind of split the baby there on what you're talking about. You are seeing some price declines because it's really a function of monthly payment.
Yeah.
If you are buying, an average 300,
yeah, because people want to get burned by their prepayment, which sounds ridiculous. We talked about another.
Well, that's on mortgage bonds.
I know, but still, it seems like you should get punished for that.
Well, so here's the thing. I probably still have. I was in, listeners, years ago. I always called it a previous lifetime, but when I was younger in the 2000s, I was in real estate. I was a home builder. I was a real estate developer. That was kind of a segue of me growing up in the construction business with my dad and my uncles. We did construction. I ran heavy equipment. I actually worked with my hands at one time. I used to say I wouldn't last a week in that world.
No, he's a pretty boy now.
I don't think I'd last a day now. But so back in 2008, 2009, when everything just fell apart, I probably still view some of my opinions through that lens. And when you started seeing rates going up, man, I just thought these poor realtors. It's going to be dog eat dog, and if you're new in your career, and it's hard to sell real estate. It's hard to get established.
It's true. Here's
the difference between what I experienced in 2008, during that time period, 6, 7, 8, 9, and today, Michelle, is there was way more supply to demand than there is now.
Correct.
Now there's demand still outstrips supply.
Yes.
Which is why you still got
significantly.
Right. You still got somewhat of a healthy housing market, and in Baldwin County probably was a poor example to pick on, particularly because we're one of the fastest growing counties in the United States, right?
Yes. We're immune to some things.
To some things, right? Yeah. We're where a lot of people want to be. So
correct.
And there is definitely a lack of I know some people will disagree with this, but compared to the population growth, there isn't the same corresponding housing growth in the area.
No, there's no. I know that for a fact because we do the math at work.
That's right. So hence there's more demand than supply. So for that particular thing, I would say I was off. I guess with your input, consider, Michelle, we'll circle back to this maybe in 6 months to a year, and we'll see if maybe that actually did play out true. I hope not, because I have a lot of realtor friends that just work their butts off. They do a great job. They take care of the clients. The realtors that helped me buy my home were fantastic. I know your realtor was great. So, you pull for them. Yeah, I just know from my own personal experience, it can get tough, and especially tough when you're just trying to get your career off the ground. So, very good.
All right.
What's
okay.
Next?
You've stated on multiple occasions that when the stock market experiences high volatility combined with the gains being difficult to achieve, that many investors will do what is called a flight to safety and look for more conservative investment choices. Well, according to recent research by the investment company Institute, sounds made up, the total amount of dollars in money market funds has been increasing by roughly $40 to $80 billion per week.
Wow.
That is big numbers. Right. We're coming up with another one. Or a total of $5.47 trillion, an increase of nearly $1 trillion from 2 years ago. So obviously your crystal ball was correct, but would you mind providing some context around this news?
Well, I find this amazing, and I'm
still not. I mean, the market funds are confusing me because they're short term.
Well, let's try that then.
Okay.
All right. Now, when you say they're short term, Michelle, what you're getting mixed up in your mind is there's no surrender period on them. There's no guarantee of 3 years, like a CD. There's no 1 year guarantee. Like on a MIGA, there's no 7 year guarantee. You could buy a money market today, sit in it, and if interest rates decrease pretty significantly over the next 12 months, the rate on your money market account is going to trail that and go down, right?
Okay.
Now, so yes, historically, we may not have periods of high interest rates because typically we were able to beat back the inflation booger, if you will, pretty quickly, and the Fed was usually pretty quick to keep rates low because they want to see growth. What we've seen is persistent inflation, and really the only real tool that the Fed has that has any real teeth is high interest rates, which depresses demand because things are now more expensive to buy and finance, and so on and so forth. And so typically, what you're seeing now is you're seeing money market rates stay at, again, relatively speaking, high rates, at least for the last 15, 16 years. And consequently, you're seeing a flight to safety. It's funny, even today, and I don't sit and watch the market all day long, but I keep my finger on the pulse.
Thank goodness.
The market,
Drive you crazy.
The Dow Jones, I think, was up, 400 or 500 points at one time. It only closed maybe 80 up. But, within one day, we are seeing volatility sometimes of 800-point swings on that market. S&P, you're seeing 1% to 2% swings in single days. That's historic volatility still. Not as bad as it was during COVID, but it's still historic volatility. And honestly, there's a lot of people just don't want to watch their money go up and down. especially
Yeah, I prefer the steady Eddie myself.
Well, think about this, Michelle. What if if you're in the what they call the retirement red zone, where you got 5 years or less to retire, or you're retired, and you've only got a certain amount of time to either put more money into that investment or save it, then you're probably going to look at what we've seen, some flight to safety. Now, these high interest rates are not going to last forever. It's not this is not a total financial plan. This is not a total investment choice. I'm definitely not telling all the listeners, hey, just go park your money in a MYGA or a money market account. But the point of this whole episode is maybe there is an opportunity, particularly for those of you holding cash, to take advantage of what is pretty strong interest rate returns on things that there's no such thing as 100% guaranteed on any of the stuff. All investing involve risks. Even if you drill down in the fine granules of the U.S. Backed securities, there's still going to be some element of risk there. But generally speaking, these are lower risk investments. So that's what you're seeing, Michelle.
Okay.
All right. What we got?
Well, let's talk about one of our favorites, annuities. I feel we've been pretty fair and I dare say balanced around this discussion. Fair and balanced. What are we now?
We Fox News?
Maybe, arguably. Okay. Apparently, we are now Lower Alabama's source for fair and balanced coverage of annuities.
Oh, that's our tagline.
Yeah, it could be one of them.
No.
Hashtag. No, okay.
Annuities are just one piece. I definitely.
Right.
What was your hashtag, though?
We do talk about them a lot.
Yeah, well, because they get so much misinformation out there.
Right.
Yeah,
so we're trying to set it straight.
Well, they're a tool in the toolbox. The problem is, as anybody that knows me and anybody that's dealt with me in my practice, a lot of times that the guys and the gals that are really strong into selling annuities, they have a hammer and everything turns into a nail. Is the problem. Okay.
That's funny. Okay. So anyway, a handful of years ago, you stated that one specific type of annuity would see a significant decline in popularity over the ensuing years, variable annuities. Well, according to Insurance News Net, variable annuity sales are down to their lowest point in 25 years. So I guess congratulations on your crystal ball. But can you explain why this is happening? Because it appears that sales are up across the board for all other types of annuities.
Okay, that's it. Yeah, so variable annuities, getting less from the dust, right?
Right.
So here's the thing. So the first thing you got to understand is what is a variable annuity? Okay, so a variable annuity, I don't sell them. They typically require FINRA registration, a broker-dealer. There's various ways to sell them. I can just tell you as a fee-for-service, fee-based financial advisor, I don't do variable annuities. So take everything I say with a little bit of grain of salt, even though I do have some experience with them in the past. I can tell you that the primary structure of variable annuity is you put money into this annuity. It's held in what's called a sub-account. Now, as opposed to other types of annuities, including the ones we talked about today, which were MYGAs, fixed index, fixed annuities, SPIAs, none of these other type of fixed annuities will have any of their premium, the client's premium dollars actually invested directly in the market. They will, now some of them like a fixed index annuity will track the market. Usually they'll do like an S&P kind of tracking thing, but there's no direct investment in the stock market. Variable annuities has direct investment in the stock market. So what happens with variable annuities is just like with any other investment account, if you're invested in the market, and of course, depending on your aggressiveness, your risk tolerance, you may see a lot of movement up and down in that sub-account of your variable annuity balance. So that can be alarming. A lot of times people buy annuities for kind of predictability and growth and income. And if you're seeing your dollar amounts in those variable annuities, your investment account, premium amount going up and down quite a bit, it can be a little alarming. The other problem too, Michelle, is historically they've had really high expenses.
Yeah.
Yeah. I mean, again, forgive me, you VA salesmen that are still out there, but generally speaking, you're talking 2 to 3% off the top for these VAs.
Oh.
So what the industry realizes this, there's a reason why annuity sales are down to their lowest point in 25 years. There's a reason they've been decreasing is because quite honestly, the insurance industry has come up with better alternatives.
There you go.
Yeah, you've got things that have...
It's nice to have options.
Well, they have a lower cost structure, and they realized, what a lot of people realize, that a lot of times, not always, but more often than not in retirement, people are more concerned about not losing money than they are concerned about making a bunch of money. And one of the things of variable annuity is it gave you some upside potential. There would be some income riders. There'd be a death benefit rider and all that. But the one thing they can never do is still take away the anxiety of seeing that sub-account go up and down. That's just part of the structure of the annuity. And that's why they're getting left behind, in my opinion.
Okay.
So, and if I'm wrong, VA salesman, give me a shout.
Sure.
Okay.
All right.
Very good. You got one more?
Yes, and this is exciting because this is where you can address your crystal ball and make a prediction. So I don't think the listeners want to hear you wax poetic about the status of NATO or the future of the ice shelf in Antarctica.
I have opinions on it.
not looking good, but we got time. All right, so let me get through your big mouth pointed in a pertinent direction. What will the next 12 months of Gulf Coast financial advisors look like? And this will also be real fun to revisit this time next summer.
All right.
So let's massage it up.
No, I don't have any notes for this. This is off the top of the cuff. This is what I believe. What I believe. We're going to put a pin in it, come back to it.
All right.
Yeah, maybe we'll have our editor and producer, Chaz, cut this out so we can reference it a year from now. I think that based on the response to this show, I think based on sometimes it just takes years. When you go independent, any of my competitor brethren in this area or any area will tell you, it takes anywhere from 3 to 5 years for people to consider you legitimate. That was true in my case. Now, once you get over that hump and you start getting referrals and you start doing
I'm taking notes, by the way.
Yeah, you start doing marketing things and you start going that direction. This is where I'm going with this, Michelle. I think that we will double in revenue growth over the next 12 months.
Let's hope.
Now, I don't know if we'll necessarily double in client growth. I think that as with anything, when you're in this business for a long time, you just tend to kind of keep moving up market, if you will, it's called. However, that said, I don't carry minimums in my thing.
That's nice. Thank you.
Yeah, I had one client come in years ago when I was new to the practice, started with a nominal amount, hit it big with a couple business opportunities, and now he's one of my largest clients. So who am I? What if I shoot him away?
Cinderella story.
Yeah, well, hard work story, but fair enough. And I think that coupled with a couple of key points, Michelle, will do the growth. Here's what's going to happen. We're already on a great track on offering services that I think distinguish us from some of our both independent competitors and our captive or wirehouse competitors. We're able to do the full comprehensive financial planning in-house. We're able to do the investment management. We're able to do through my partnership with Will Stye, another financial advisor that is a CPA by training. We're able to do tax planning. We're able to do some work through you with your University of Denver JD, plus our other affiliates. We have attorneys. We can do estate planning. There's just so many things we can do in this. So I think that'll drive revenue growth double. I think client growth will trail that a little bit. And I do think that we are at 2 offices now, Fairhope and Orange Beach. I think with 1 year, we'll have both those offices just rocking and rolling. We'll be looking at a third.
Well, I look forward to it.
There you go. That's my prediction.
Awesome.
All right. So, listeners, I hope you enjoyed getting a little peek behind the curtain of how I form my opinions and my predictions. And more importantly, that I'm willing to admit when I'm wrong,
That's right.
Which hopefully isn't very often, but still. So now, to our listeners that have more questions about their various investments and the topics that we discussed in this segment or in this episode, we invite you to reach out to us. You can call us anytime at 251-327-2124, or you can, and if you get us, here's the thing. I've been meaning to say this, Michelle. So
what's that?
Because we've been getting calls from the radio show. And
thank you, listeners.
Yeah, it's very cool. And here's the thing. If you call that number, if I'm not in the office, I forward the number to me. And so I will answer the phone. If you call, my dad said something long ago. I'll say this in closing. When I was back in real estate, when I was doing development, and my phone would just ring all day long. And one day I was really complaining to him about it. And he said, son, I'd be worried when that phone quits ringing. And that has hit home with me so much that what I do is I just make a point within reason. I do have a life, but I try to answer the phone if I'm out and about, because a lot of times we get great calls and great conversations and questions and appointments from the radio show. So point of that is call 251-327-2124. You're not going to talk to some random stranger. You can talk to me.
Or ChatGPT.
Our ChatGPT, that's out. You're going to talk to me if I'm available to talk. You can also make an appointment with us on our website at gulfcoastfa.com. One more time, that is Gulf like the Gulf of Mexico, Coast, FA is in financialadvisor.com. Well, folks, that's it for us here this week at Coasting in Retirement. I want to give a huge thank you to my lovely co-host, Michelle E. Melton.
Welcome.
A thank you to our awesome radio station, FM Talk 106.5 out of Mobile. Many thanks to the provider of our show music, that's local band Sloth Racer. And I think you can find them at slothracer.com. Sloth like the slow mammal, the music is not. And as always, a sincere appreciation for all of you out there that have been listening and joining Michelle and I on this journey. We would obviously love to be a part of your financial journey as well. Until we talk again next Sunday, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. Prime Capital Investment Advisors, LLC, 6201 College Boulevard, 7th floor, Overland Park, Kansas, 66211. Prime Capital Investment Advisors, LLC, doing business as Prime Capital Wealth Management and Qualified Plan Advisors, and Gulf Coast Financial Advisors are not affiliated. Gulf Coast Financial Advisors, Prime Capital Investment Advisors, Prime Capital Wealth Management, and Qualified Plan Advisors do not provide tax, legal, or accounting advice. This content has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. The information provided herein is not a complete analysis of every material fact regarding any strategy. It is intended only to provide insight into the opinions of the author. All information presented is for educational purposes only and is not an offer or solicitation for the sale or purchase of any securities. Content offers commentary and generalized research, not personalized investment advice, and is for informational purposes only and does not constitute a complete description of our investment services or performance. All investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified legal professional and/or tax professional before implementing any strategy discussed here.